G'day, welcome to another Eureka Interactive. I'm Alan Kohler, and today we're going to continue our series on peer-to-peer lending, which, as I've said before, is all about helping it to educate you on this new asset class, the pitfalls of it, the benefits and so on. And today's is called ThinCats, which is a play on the word fat cats, of course. And its Australian CEO is Sunil Aranha. Now, perhaps we should start with just the sort of the ownership structure of your business, because it shares the name and structure with a business in the UK, ThinCats. Is the Australian business a subsidiary of ThinCats UK or not?
No, we are actually a joint venture, and ThinCats UK started operations in 2011, and they had developed the IP and the technology and a market rationale.
And how much of your business do they own?
25%.
Right. Would I be right in thinking that you're the main founder of the four?
Yes,
right.
I am.
And who are can you tell us who the other three are? Are they
absolutely
private people, or are they?
Yeah, absolutely. In fact, I am the main founder, but I'm not the most integral part of the team. In fact, it's everyone doing a great job. So the others are our chief operating officer, who actually is a chartered accountant, who has experience in Morgan Stanley, JP Morgan Chase, and another of our members is a senior partner of a mid-market accounting firm, and a third person that we have is a person from the technology sort of world and background. And finally, we have a chief risk officer who's actually the ex-head of risk for Citibank Australia, and has been in credit and lending to small and middle-sized business for 35 years. So
what's your background?
My background is also banking, but I've had the opportunity, sometimes not very fun, but the opportunity of being a small business as well. And so as a small business and as a banker, I saw the gaps between what the banks sort of sell to small business, which is product focused, and what small business needs, which is working capital focused.
And why did you get into peer-to-peer lending?
It was an evolutionary process. So after finishing up with banking, I was actually running a small debt advisory that helped small business get a better deal from their banks. And at the same time, looking around for things that were happening in different parts of the world and peer-to-peer.
So you were negotiating for small businesses with their bankers?
Yes.
Right.
Well, if they gave me the mandate. A small business gets an overdraft, which is come-and-go money. Come-and-go money is usually the most expensive form of money, while they may actually need money for 3 months at a time in a self-liquidating way, which is much cheaper, or a term loan, which is much cheaper. So a term loan is 6.5%, an overdraft is 11 or 12. Which is the most expensive form of money for the bank. And yet they all have an overdraft. Usually, if you look at a trading account of a small business, they have $1 million overdraft limit, $800,000 never moves. Because it's some kind of fixed debt that has been created God knows when. And if that could be moved into a 6.3% loan, they're saving 4%. So that was really the angle I was taking. And trying to help them also in terms of the risk view that the banks took, because the banks usually don't change the deal they've got with you unless you ask for it.
But you talk about secured loans. So what's the security? How does your security work?
We step in is that above that overdraft rate for loans which would be secured against the actual business of the company, which might usually be free, especially if you've borrowed money against your house. So we take a first charge or fixed and floating charge over the business, and we record that on the PPSR.
Taking it director's guarantee?
Yes, always.
But what's the yield that the lenders are getting?
Okay. Once again, we've done about 10 loans, and all of them have been between 11.5% to 14%.
In the hands of the lender?
In the hands of the lender, and the interest rate that is publicized. So we don't actually take any spread or any margin, if you will.
But you take a fee though, right?
Yes, from the borrower.
Wes wants to know who reviews the borrower's risk levels.
So essentially, I'll break this down to 2 elements. The first element is we look at every borrower that comes through from the point of view of eligibility for the platform. And by that I mean we are not making any recommendations, neither are we sort of providing advice on risk. All we are saying is that we want to make sure that our platform is sustainable, so we'll try and make sure we vet what goes on there. to be eligible, and hopefully the lower the defaults, the more the lenders.
Do you talk to the borrower as well?
Oh, absolutely. So it's part of the KYC, and there are 2 points that
KYC?
know your customer.
That information is all placed
On the website.
on the website,
Yes.
and it's available to the lenders.
Yes. We have a Q&A section as well on the platform. So anytime a lender wants to ask a question, before they bid any money on a loan, they can ask the question, and we will get it answered, either directly or with the borrower.
Well, just explain to us the process for a lender. If any of the people watching today wants to, say, lend $10,000 to somebody at 14%, how do they go about that?
Okay. First step is one has to register on the platform. And when you register, you'll be asked to fill up an application form, which will require to say whether you want to come in as a SMSF or in your own personal name or through another company structure or a trust. And once you've filled up that application form, there's also as attachment to that an accountant certificate that requires to confirm that you're a sophisticated or a wholesale investor, because that's all we are targeting at the moment.
One more question. Can SMSF, self-managed super funds, invest?
Absolutely. In fact, 50% of our registered lenders or participating lenders are SMSFs.
You've answered all my questions.
Thank you.
Thank you, Sunil. It's been great talking to you.